What are the best bonds to buy? In this episode, we'll talk about what we look for when we're recommending bonds to clients and other people. We'll talk about bonds and bond funds too. And at the end of this episode, we'll talk about why you hear so much about investing in stocks, but hardly anything about investing in bonds when it's actually more important about how you invest in your bonds. Hi, I'm Bridget Sullivan Mermel, and I own a fee-only financial planning practice in Chicago, Illinois.
And I'm John Scherer. I run a fee-only financial planning practice in Middleton, Wisconsin. And before we get started on this conversation, Bridget, I'm really looking forward to it, but I want to remind our viewers to hit that subscribe button. That helps us, other people find us on YouTube. And so if you hit subscribe, let's get on with talking about bonds and how to buy them. Last episode, we talked about, or recently anyway, talked about how much we love bond funds or bond ladders, right? Setting up a bond ladder to produce income for retirement or cash flow in retirement. And then the next question, like, how do you actually do this thing? Like, what kind of bonds do you buy? And I'm really interested to hear how you approach this with clients.
Well, it's going to be a different approach depending on their situation. So first of all, I love US Treasury Strips in IRAs, okay? Especially if people are retired and we create that cash flow. We did a whole episode on how both of us love doing that. So that's my number one is if it's an IRA, then I'm more attracted to Treasury Strips. If the person's younger, maybe or maybe not, but when they're retired, that safety of being backed by the government and having that cash flow, even if it's more than what they need, then I'll buy a separate individual bond. I like it because it's safe and also they're marketable. So a treasury strip, you buy them on Schwab or I'm sure the other custodians have them too, or you can buy them through Treasury Direct. But if you buy them on Schwab and you need to sell one, you can sell it. It's not, and it's not excessively expensive to sell or hard to sell. You just, you can either just do it on the website or you might have to make a phone call, maybe. But it's been, and I've had both situations. It seems like they've upgraded the website, so I didn't have to do that the last time I had to sell a bond. But it's easy and it's not expensive and they're marketable. And if somebody were to inherit them, again, they can sell them. It's not hard to sell them. Some bond, we can talk a little bit about corporate bonds or municipal bonds, but they're not at all as easy to sell. Anything else except for the treasuries are not that easy to sell. There's just not a ready market. So that's another reason why I like treasuries.
I love the idea. I wanted to sort of pull out one of the things you said in there, and it's the idea, and I think we both espouse this in our practices, is that when we're talking about bonds, safety trumps yield. Right? Not like we're not trying to get good returns, like, yep, that's nice, right? But the important part is that safety aspect of things, at least that's how I look at that, especially when you're buying a US Treasury bond, a Treasury strip like we do for our bond ladders, CDs that are FDIC insured, certain agencies, agency bonds from the government that are backed by the printing power of the government, that you know what you're going to get, right? You know that you're going to have this and that money will be there at the end of the bond term. And that I think is a really significant difference, at least that's how I look at it compared to corporate bonds. Sure, maybe we can get better yields on corporates. There's some drawbacks, as you just mentioned. But, when you go back to 2007, 8, 9, and suddenly the stock market's going like this and dividends get cut. And now, hey, if I'm wondering if the company that I've bought a bond from is going to pay me back, that is not an awesome place to be. Right. When we have the safety things, we know that the money is going to be there because the government can literally print money. That is such a big part of the bond side of things for me. I just wanted to make sure to draw that out a little bit.
Yeah. And when I have looked in the past with corporate bonds, it looked to me like you're taking the risk. Like you said, you're not sure if you're going to get paid back if the company goes under. You're not sure. You're not an employee. Like, you're pretty far down on the list of who we're going to pay back. You're not all the way at the bottom, but you're pretty far down on the list. A corporate bond is. So you're taking more risk. It's hard for them to gauge the risk. they are not able to get this financing with a bank or somebody else. So again, it's higher risk and you have no upside reward. So if the company does well, you don't get any more money. So investing in, if you like that company, invest in the stock and then go buy a treasury, you know, because you'd have more upside reward if you invest in the stock because it can keep going up. And with if you buy the company bond, all you can do is get whatever they're paying in interest or lose it all. You know, and so there's no potential to make any more than that. And yeah, so all you can do is get paid back or lose it. Whereas with, and if there is a recession coming up, we'll be seeing some people not getting paid back, and that doesn't feel good.
Right. You know, one thing as we're having this discussion, it's super interesting to hear how you think about it and where we're similar and maybe different in some things. And we'll talk about bond funds in a little bit, but one of the things, you know, most of our clients are at or near retirement. So we're looking at this bond ladder idea, right? You know, producing cash flow in retirement. And one of the things that we're getting some questions about today is, you know, interest rates are rising. And so the value of bonds is dropping. Those of us that have bond funds are seeing those, you know, we're having negative returns, you know, this year. And I think it's really important to remember for viewers that when you buy an individual bond, like we're talking about here, it's kind of like buying a CD, right? The people are familiar with that. Listen, in 5 years, the company, the government in this case, will give me my $100,000 back. And in the meantime, I'm going to have this interest return, right? That sort of concept. And so even though with rates rising, my bond might be worth less, when I look at my Schwab statement, it says a lower number. In 5 years, it's worth that number. Just like in 5 years, your CD is worth that number. It might be worth less now. We don't even look at the returns on that because from that perspective, it's about the cash flow. It's that cash is going to show up in 3 years, 5 years, 7 years, right? And it can be confusing. It can be sort of disheartening when the stock market is dropping and you go, geez, my bonds are worth less. And you know, it's like, yeah, if you sell them today, and like you said, they're marketable, but if you don't sell them, they're still worth exactly what you thought they were going to be worth 2 or 3 or 4 or 5 years ago. Right. And it's not that easy to think about that, right? It doesn't feel like that when you see your statements.
Right, exactly. So I tried to get people to ignore what the ups and downs of on an individual bond is and just say, look, this is what we're looking for. We're looking for, it's still, you're going to pay back. It's still going to pay you how much we thought it was going to pay you. Isn't that great? That's what we're looking for. So let's switch topics to bond funds. So I mentioned that I really like treasuries in IRAs, but there's a lot of other things out there. So let's talk about when we use bond funds and what we look for in bond funds. So
that's great.
Yeah. So
well, before we start on this, Britt, let's just explain, just to make sure everybody's clear so we don't get the jargon police coming in and busting us, is that there's individual bonds, just like individual stocks, right? That's what we've been talking about. When we talk about a fund, we're talking about a mutual fund or ETF where a company buys all kinds of bonds, you know, 500, 1,000, 5,000, and we're buying that sliver, investing in the mutual fund, right?
Right. Absolutely. Yeah. So let's talk about what we do with bond funds. And this is where we might diverge a little bit. So with bond funds, you know, I have a couple of favorites and I tend to like those. And they might have some corporate stocks in them or corporate bonds, pardon me, in them.
Yeah.
But I feel like the things that I really look for when I'm looking at a bond fund to pick is what's the duration, what are the expenses, just like any other stock fund, you know, what are the expenses? Is the expense rate low? And what's the average duration? Okay, now there we got jargon police for sure on that. So that's another thing I'm looking at is the duration on bond funds.
And what duration means is basically how long of bonds, right? Think of it in CD terms, right? A 1-year CD versus 5-year, the duration of the 5 years longer. So it's just how long are the bonds? That's that fancy pants word, but it means how long are the bonds in the fund, right?
It's like and I mean, I think that the bond people, it's like, how long does, what is like duration? Yeah. How long does it go?
Right.
Duration.
Yeah, exactly.
Yeah. So I like bond funds that have expense ratios less than say 0.5 for sure. So half a percentage point. And I like bond funds that have a duration of around 5 years or less.
Yeah, and it's very similar. We've been seeing even bond funds,
Yeah.
especially we do a lot of index funds, right? And so the expenses can be even a lot lower than that.
Right.
But we're exactly the same on that duration. The average length of bond that we want to see in the fund is 5 years and less. You get above that, and there's a lot more volatility, meaning more ups and downs.
Right.
And remember, we're talking about this being our pantry, right? Being the safe place in the portfolio. So having the shorter duration on bond funds means lower returns over time, but also when you have times like these, less downside. I think the only other thing that I'd throw in there, Bridget, as I look at bond funds for people is the quality of the bonds inside there, right? And people are maybe familiar with treasuries or AAA, right? Backed by the government, and then you got junk bonds on the other end of the spectrum here. And the farther down the spectrum you go, the more returns you get. But there's a reason for that. And that's, the lower the grade of the company or the bond, that means that maybe they're not going to pay you back, or it's not as reliable, right? So we like high grade, again, return of principal, not necessarily return on principal. So high grade, AAA, AA, those sorts of things, and low duration. And you can find that information out there. And if you do those two things and have a low expense ratio, I think you're setting yourself up for success in bonds.
Yeah. And I think people might recall back in the 80s, probably, there was a lot of junk bonds. And that's what you're talking about with the low ratings. Okay.
Yeah.
And so loaning a company, somebody wanting a junk bond or it's just like loaning a friend who is unreliable money, and
Well, you got a friend like that too?
no, my friends are very reliable, actually, but that comes up a lot, so anyway, you don't expect to get paid back. And what we really want with our bond investments is to get paid back. That's what we're really looking for. We want to get paid back. Another type of bond that we've talked about a lot are I bonds. And we just don't want to talk about bonds without talking about how great I bonds are right now. And so we'll mention them, although we've got several other videos on the topic. And again, so do you want to give a quick pitch for I bonds?
It's one of those things, exactly what you said. Look at some of the previous episodes. Right now, they're paying an annualized rate of over 9%, backed by the government, tax deferred. If you're not at least thinking about those, there's some drawbacks, but if you're not thinking about those, you're missing the boat. So that's a really great place to look. And again, check out our previous episodes on I bonds.
Yeah. Okay. So, but this brings up a great question, because you said you just went to some continuing education and was talking to a lot of advisors that were not an ACP or the Alliance of Comprehensive Planners. And we're talking about like how you're investing, what's hot for you guys. And that only one person mentioned I bonds.
One out of, a few dozen that I personally spoke to.
And I think
go ahead. Talk about that.
That's the same as the rest of bonds. Like, actually, why are bonds not talked about? First of all, the expense ratios are low, and like you can go buy treasuries for free, or the custodian might charge you a little bit, but it's very inexpensive. So advisors don't make as much money on bonds. Although last time I checked, there was a lot more money in the total stock market for bonds than there was in stocks. And so people aren't talking about it. And when I talk to people about bonds, I tell them, this is what rich people do. They buy bonds. They don't need to take this risk of the stock market. They don't want to take the risk of the stock market, but they want to keep up with inflation, make a little bit, so anyway, so that's what we hope for with bonds, right? Just get it back, and we want it to be safe. It's like our safe space.
That's right. I was going to say, I love that idea of, there's more money, or at least as much in the bond market as the stock market, right? Well, somebody will say, boy, the market's really down. I say, oh yeah, the bond market. Well, no, not that market, right? And we forget this thing. That's such a great point.
Yeah, well, and it's not sexy. I mean, you gotta admit, like treasury strips. I mean, I guess the word strip.
Boring.
The word strip is the biggest thing it has going for it.
Yeah, I never thought about that. Now I'll never look at those the same again. Thank you.
But it doesn't compare with the tech stocks and how much fun that is. So I think that those two reasons, doesn't engage people's imaginations, and the people in the industry don't make much money off of them, are the two reasons why advisors don't talk about them too much. And
That's
why
right.
we do. That's like something that in ACP we like talking about, like, okay, how are we doing this?
And that's maybe a great place to circle back and remind everybody that both Bridget and I are members of the Alliance of Comprehensive Planners, or ACP. And there's a nationwide group of fee-only, tax-focused, holistic planners that think similar to the way we do. And if you like what you hear on our show, check out acplanners.org to find an advisor in your area.
And before we go, don't forget to subscribe. See you next time.
That's right. All right. Bye-bye.